Assalamualaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Ardan Imam Rashid, and today I'm gonna talk about financial ratio analysis. Financial ratio analysis. Financial ratios are one of the important indicators used by a company or institution to assess business performance through financial data. In addition to measuring the financial health of a company, financial ratios are often used as a reference in making decisions and evaluating existing performance. In addition, financial ratios are also one of the important data that is taken into account for both investor and potential investor. For more details regarding what financial ratios are, let's look at the full details in the following description. Next, the first, what are financial ratios? Financial ratios are one of the financial analysis tools that can be a benchmark of or parameter in assessing the performance of a company, especially in the efficient use of resources and financial management. Financial ratios are calculated through several important components in the financial statement, such as profit and loss, cash flow, balance sheet, and so, in addition to being a benchmark in assessing the performance of a company business. Financial ratios are often used as supporting data in decision making. With this data, management can predict the right step and should occur in the future. Next, the second types of financial ratio and calculation formula. Liquidity ratio. Liquidity ratio is a type of ratio used to measure the ability of a company to meet short-term financial obligation liquidity. Ratios are divided into three types, among others, namely current ratio, a ratio that compares current asset with current liability or short-term obligation. Current ratio formula. Current ratio, current debt 100%. Quick ratio. Ratio that calculate the company's ability to meet short-term obligation without relying on inventory. Quick ratio formula, test ratio, cash plus security plus receivable current debt x 100%. Cash ratio, financial ratio that measure the company ability to pay short-term liability with cash on hand. The cash ratio formula equal cash plus security current debt. Next, profitability ratio or earnings ratio. Profitability ratio measure a company's ability to generate profit from its operation. Some commonly used profitability ratio include gross profit margin, a ratio that calculates gross profit as a percentage of sales. Net profit margin, a ratio that calculates net profit as a percentage of sales. Operating income ratio, the ratio formula used to calculate operating income before interest and tax from sales. Return on equity, a ratio that calculates net income as a percentage of equity, or in other words, measure the company's ability to earn net income based on existing equity. The third, benefits of financial ratio. There are a series of benefits found in financial ratio. What are these benefits? Here are some of the benefits. Measuring financial performance. Financial ratio provide a clear picture of a company's financial performance, including profitability, liquidity, solvency, and operational efficiency. By evaluating financial ratio over time, management and investor can identify problems that may arise and potentially affect the company's financial health. Determining the ability to pay debt. One type of financial ratio, such as the solvency ratio, provides information about the company's ability to pay long-term obligations, one of which is of course debt. By looking at this ratio, company management and investor can see the financial risks that exist. Next, comparing company performance with competitor. Furthermore, financial ratios serve as a comparison of companies with one other of competitor in the same field. That way, investor or analyst can compare how a company is performing financially, whether it is positive or the opposite. As evaluation and decision-making material, the data present in financial ratio can assist management in making business decisions and evaluating company performance. This way, the management can make decisions for the next steps that are useful for the sustainability of the company. Financial ratio analysis method. The last discussion is about the financial ratio analysis method, reporting from various existing sources. This one method is divided into two general methods. The first is common size analysis. Second, time series on forecasting. Common size analysis. The common size analysis works by comparing the change in various items with the sum of assets, liabilities, and sales. The comparison is then present in percentage form for each component in the financial statement, including the balance sheet and income statement. Through the analysis methods, a company can obtain information about the relativity or current asset, the fixed asset, and the company relativity to capital structure. Common size analysis can be used to compare financial statements from one period to another, as well as to compare the company's performance with competitors. Time series analysis and forecasting, as the name implies, this method of analysis is used to predict future financial conditions by comparing financial data within a certain period. There are several important points that need to be taken into account in this analysis, where these points can have an impact on change in the financial structure. These include government regulation, technological change, and shift in competition. That the explanation of financial ratio. Starting and running a business requires strong determination and a well-thought-out strategy. One of the important things in the sustainability of a business is business capital. With the existence of business capital, various operational interests can run properly. One of the finance companies that provides business capital loans with low interest rates and fast processing is BIFI Finance. Thank you and wassalamualaikum warahmatullahi wabarakatuh.